Nothing is cheap anymore. After a more than 50% rebound in stocks, it's almost impossible to find those good value stocks left in this market. In this video, I'll show you how to find the cheap stocks to buy and then combine it with data to reveal the 5 Robinhood stocks I'm buying for value. We're talking cheap stocks on Robinhood today on Let's Talk Money.
Beat debt,
Make money,
make your money work, creating the financial future you deserve.
Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to all you in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now nation, this market is a value investor's nightmare. That PE ratio on the stock market, the price investors are paying per share of earnings, is 34% higher than its 10-year average. In fact, you have to go back to 2001 during the height of the tech bubble to find a market as expensive as this one. But that doesn't mean there aren't cheap stocks left in this market. If you look at the sector level, those stocks in the utilities, healthcare, and financials are all trading much closer to that long-term average on a price-to-earnings basis, and you can find cheap stocks to buy in any sector if you know where to look. If you're gonna make money in this market, you have got to be able to find those deals, how to find those cheap stocks nobody is watching. That's what I want to do in this video, show you how to find those cheap stocks to buy, where to look for those deals. Then I'm going to combine this with other analysis to reveal the 5 Robinhood stocks ready for a breakout. Nation, this is exactly the kind of research I did when adding Conagra Foods to our 2019 dividend portfolio in February of last year. A stock that helped the portfolio beat the market last year and has surged 74% since. I want to get into that list though, and I'll show you how I found these and what I'm watching as we go. Stick around though, because our last stock in the list is not only the cheapest in valuation terms, but also gives you a 4.4% dividend yield while you wait for those shares to run higher. Our first cheap stock here, $60 billion virtualization leader VMware, ticker VMW. Now VMware is an industry leader in virtual machines for data centers and networking, one of the biggest trends in IT and really primed for a wave of growth in that network virtualization. The company's vSphere and hypervisor products are the gold standard in the industry, and the continual subscription service revenue from the customers really helps to stabilize those sales. The company has a price to earnings to growth ratio, something I'll explain in a little bit, of just over 1.2 times, which is 33% below that 1.8 multiple it traded at within the last year. I like this measure, the PEG ratio, much better than the more popular PE ratio for finding cheap stocks. Something else I'm watching on these cheap stocks though is the short ratio. That's the percentage of the shares sold by speculators on a bet against the stock price. It's a sign of the bearishness and can actually be a great clue to those beaten down stocks ready to rebound. Just over 11% of the shares available in VMware are sold short, which is extremely high for a large, profitable company like this. Now, finding cheap stocks is one thing, and I'll show you what I'm looking for later in the video. But finding cheap stocks ready to run is something completely different. For this, you're going to need a catalyst, a reason these stocks can break that share price weakness and head higher. In fact, nation, if there is one thing that I can point to in more than a decade as a venture capital analyst and working with private wealth clients, one thing that helped put me in the top percentile of analysts is that ability to find a catalyst in these stocks. Now for VMware, besides that great long-term investment idea, Dell recently announced that it may spin off its 81% ownership stake in the company. And that could allow more flexibility and control at VMware and help drive those valuation multiples higher. A big part of that catalyst, though, has also been the fact that management has already said a spinoff would include a special dividend paid to all VMW shareholders, which would improve investor sentiment. Analysts have targets from $115 per share on the low end to as high as $200 each over the next year, which would be about a 40% upside from here. Now, before we get on to those other 4 cheap stocks that I'm buying, I want to get your opinion on this. Do you prefer cheap stocks or growth stocks as an investment strategy? So do you like to look for those stocks selling at a discount or those with those surging profits no matter what the price? I'm going to show you how to combine these two a little bit later, but which do you prefer, value or growth, and why? So scroll down and let us know in the comments below, value versus growth and why. Next on our list is a $16 billion drug maker for rare diseases, BioMarin Pharmaceuticals, ticker BMRN. Our shares of BioMarin did plunge 38% last month when the FDA requested more data on its gene therapy drug Roctavian. It's a promising drug, and obviously in how the shares reacted, it could be a big producer for the company. Now, what the market is missing here, though, is that BioMarin still has a strong lead on its competitors in that therapy. The last patient to enroll in those phase 3 trials is going to complete those 2-year trials in November of this year, which means the data should be available late this year or early next. That could completely reverse the slide, and there's a lot more to like about this company. BioMarin is building a world-class portfolio of genetic disease therapies. Heavy R&D costs have kept profits hugging that flatline for the last year, but sales could boom over the next few. The company has a partnership with Sanofi to market its Aldurazyme, and it's got a strong 2021 pipeline. That plunge in the shares brought the PEG ratio to just 0.97 times, which anytime you can get a stock for under 1 times its price to earnings growth is a good sign. This is a 28% discount to the PEG multiple where the stock traded just last quarter. The short ratio here is about 6.5%, which is still pretty high considering 99% of these shares are held by those large institutional players like hedge funds and market funds. 23 analysts have price targets from $77 a share to as high as $188 per share over the next year. Not a single ranked analyst has a target under the current share price. Now, these are all strong companies with solid catalysts, reasons for that share price to rebound higher. In fact, I'm putting all 5 of these into my paper portfolio on Webull and will be buying each later. I love that paper portfolio feature on the app, and because I can test out strategies and follow stocks until I'm ready to buy. Look in the link to Webull in the description below and get a free share of the stock worth between $8 and $1,000 when you make your first deposit. Next here on our list of cheap stocks, pharmacy leader CVS Health, ticker CVS, and its 3.2% dividend yield. CVS has a lock on healthcare delivery and benefits from that in-store effect, selling higher margin items along with groceries. And the company is front and center on the virus testing and could see a huge upside on the eventual vaccine administration. CVS beat expectations for earnings last quarter by 17%, and this is a solid value play at just 1.14 times on a price to earnings to growth basis, half of what it was late last year. I really like this company, especially as a hedge on my own healthcare costs. We're all getting older, nation, and healthcare costs are out of control. What better way to hedge those costs than by investing in what's probably the most broadly integrated healthcare company in the world? And CVS has been building this for more than a decade, adding pharmacy benefits manager Caremark in 2007 and insurance with Aetna in 2018. It basically has a hand in every step of healthcare delivery and can use that to squeeze out every penny of profit. Analysts have targets ranging from $73 on the low end to as high as $104 per share over the next year. Think about that. Not only are the lowest analyst price targets about 17% higher than the current price, but you get that 3.5% dividend yield while you wait. We've still got 2 more in our cheap stocks list, but I wanted to detail here what I'm looking for to find these stocks, and this is something that a lot of value investors just don't understand. The problem is you can't just go looking for those cheap stocks. For example, most investors are going to go straight for that PE ratio and buy the cheapest stocks, the ones with the lowest price to earnings ratio. But by doing this, you miss out on a lot of opportunities. Hell, even at its 2009 low, shares of Amazon traded for 86 times on a price to earnings basis, when the rest of the market was falling to 10 times earnings. So if you were just looking for those low price to earnings stocks, you would have missed out on an investment worth 34 times your money. So I look for the PEG ratio, that's the price to earnings to growth instead. This is the traditional PE ratio, so price divided by earnings, then take that divided by the growth rate of earnings. What this does, it helps you find those growth stocks that are also relatively cheap. For example, if we look at the stats on Amazon again, the price hasn't traded below 72 times earnings, which is definitely not cheap. But the PEG ratio has actually been close to 1 times as of last September. So using that 1 times PE ratio as a good value signal, you could have doubled your money in shares of Amazon just in the last year. Now I'm going to share 2 more ways to look for these cheap stocks and how to tie all this in with some Robinhood statistics to find the ones that Robinhood investors might be overlooking. But we're going to do that next because I want to get back to our list. Our 4th cheap stock, $17 billion media giant Viacom, ticker VIAC, and it's another one that's going to pay you to invest. The company is a product of the Viacom and CBS merger late last year and just creates a much stronger media and content machine. Together, it has a better control over the entire process, from production through CBS studios to distribution in cable and streaming. Now, the breadth of distribution here really helps to mitigate the loss on those pay TV business, and the company was able to beat earnings expectations by 34% last quarter. Now, Viacom has typically traded below that 1 times on its price to earnings to growth ratio, so this one isn't quite as cheap as it may seem, but I still think there's a lot of value here. Nearly 17% of the shares available are sold short, so a lot of negativity in the company that's very closely held by insiders and institutional investors. I like the potential in that merger, and this one could be one of the big surprises if that share price takes off and those short sellers are just squeezed out of the trade. Analysts have price targets ranging from $22 each on the low end to as high as $45 per share over the next year, and you get a 3.5% dividend while you invest. We've still got one more cheap stock to highlight, the least expensive in the list in fact, but I want to show you two more signals that I watch for in picking these investments. First is, as you've heard me talking about, the short ratio, which is the percentage of the shares available that are borrowed and sold short by short sellers. So when an investor thinks the price of a stock is going to fall, they can borrow the shares and then sell them to someone else at the current price. And this means they have to buy them in the market later on to be able to clear that borrowed account. Of course, the idea is that when they go back into the market later, the share price is going to be lower, and so they can make money on the difference between selling at that previous price and the current lower price. You can find the short ratio on any investing platform, and how this helps me find cheap stocks is as a contrarian measure. So if you think about it, cheap is just a perspective on the stock price. You're saying that the shares are worth more when the market's saying it's not. The higher that short ratio, so the higher percentage of the shares sold short, then the higher conviction the market has in thinking those shares are overpriced, or at least not cheap. Now, another reason why I like those high short ratios in my value stocks is because if that price does climb, especially if it jumps on something new, then those short sellers get scared out of their trade. They rush back into the market to buy those shares and clear their account before the price goes any higher, and that rush of investors in turn causes the shares to go even higher. The second thing I'm watching here, and this is how it all ties back to Robinhood, is I'm looking for the number of Robinhood investors holding those shares. This is going to be another contrarian measure because I want to see stocks with fewer investors holding those shares, or maybe just a flat or declining interest. For example, in shares of Viacom, while about 21,000 Robinhood investors do hold the stock, you can see the interest has been pretty flat over the last few months. Similarly, in another stock we'll look at, AIG, only 4,500 investor accounts hold it, so still the potential for an increase in investor sentiment. And AIG is going to be the next stock that we'll look at, and I really like this one. I recommended it and put it in our dividend portfolio last April, and the shares are already up 25%, but I think this one has lots more room to run. In fact, AIG is one of the top 10 stocks recommended by analysts with an average price target that's nearly double the current price. The company did take a hit on those coronavirus claims last quarter, but we are seeing an improvement each quarter in those catastrophic claims, as well as the financial services side. Management is working through its plan to shave $1 billion off the operating costs, and that's going to support earnings for at least the next year or two. Shares here trade for just 0.59 times on that price to earnings to growth ratio, and just 11 times on the traditional PE ratio. So this is not a heavily shorted stock, but is still trading at less than half its 52-week high and pays a 4.3% dividend yield while you wait for the shares to rebound. Of the 10 analysts surveyed here, price targets range from $32 a share at the low end to as high as $44 each over the next year. So another one with a unanimous opinion on a higher price. Click on the video to the right for the 5 Robinhood stocks investors don't want anymore. 5 stocks you don't want to be left holding. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.